You don't have to be quiet yet. We've got a couple of minutes before we start. It's like expectant silence.
I've already said, I think I literally don't take it personally. I do. Yeah, that's why I'm here. This is not my role.
Well, I can go straight from
Okay, I think that is us at past, so we will make a start. Good evening, everybody, and welcome to a very warm Field Fisher London office for those of you who've joined us in person, and a warm welcome as well to those of you listening online for this evening's panel event on sustainability-linked loans and their use in funding the energy transition. My name's Anna Crosby. I'm a director in Field Fisher's London Banking and Finance team. My practice is very broad, specifically focusing on energy finance, but sort of across different finance products, from corporate lending through project financing, through commodities and prepayment as well. And I work across sectors within the energy wider sector, so traditional energy methods like oil and gas and mining, but also focus on renewables from offshore, onshore wind, hydroelectric, and latterly hydrogen as well. So you're all very welcome to this evening's event. I also spearhead our ESG finance initiative within the Field Fisher team here, and so the concept of sustainability-linked loans within the energy transition is something that has come up with increasing regularity, and so really something that we're looking forward to discussing this evening. And I'm delighted to be joined by a stellar panel of industry experts, both within the sustainability side and on the energy side as well. To introduce them all, oh, and it is working. on my right, far right, is Emily Fairmont, who's a partner at Baringa Partners. Emily is Baringa's ESG and sustainability lead, and she works across financial services, advising clients on their ESG and sustainability needs and focusing on generally ESG and sustainability topics. She has a huge knowledge of sustainability-linked loans and has done extensive research on publicly available information related to sustainability-linked loans, and in particular on their impact in the context of ESG and transition. She is also passionate about assessing the impact, and in particular looking at the challenges that have come across ESG and sustainability-linked loans, in particular in association with greenwashing, which I'm sure is something that a lot of you will be wondering about when you think about oil and gas or energy and sustainability-linked loans. So Emily, we look forward to hearing your thoughts on that. To my immediate right is Anne Delouis, who's head of sustainability CEMEA at the Norwegian bank DNB. Anne is responsible for advising clients on a range and all aspects of sustainability and green lending, so bonds and loans as well. And she also advises on general transition issues. And she really is uniquely placed to do that because prior to her current role as head of sustainability at the bank, she previously worked for 12 years in energy finance, advising oil and gas and wider energy companies. So welcome, Anne. To my left is Suchita Woodward, and I need to move the slides, who is Chief Counsel, Corporate and Finance at Harbour Energy. Harbour Energy is the largest independent UK listed oil and gas company, And Suchita has responsibility for all of their corporate or major corporate and finance legal work. And that included dealing with the implementation of Harbour's latest financing in 2020, which contains sustainability-linked credentials. So she's expertly placed to tell us about everything from a borrower perspective, both in terms of the implementation of sustainability-linked loans and also in terms of the ongoing day-to-day monitoring and compliance requirements that the company has. And last but by no means least, but we had to go ladies first, we've got Nick Lyon, who is a director in the corporate and investment team at Wells Fargo, specifically sitting within their EMEA Energy and EMEA Energy and Power team, I'll get my words out, where he focuses on upstream and midstream oil and gas companies. Nick's got many years of experience in the energy sector and has an increasing focus on transition matters, particularly as they're now impacting clients on a much greater scale. Thank you all very much for joining us. We're looking forward to hearing your thoughts on sustainability-linked loans this evening. Now, when we spoke about sustainability-linked loans and discussion for this panel, we really wanted this to be a practical discussion looking at real-life insights in terms of how you set up and implement sustainability-linked loans, as well as actually looking head-on at the challenges that face sustainability-linked loans within the energy sector in particular. But before turning to the panel for their thoughts, we thought it would be helpful if we just set out exactly what we mean by sustainability-linked loans, or SLLs for short, because sustainability-linked loans is quite a mouthful. So it's useful, I think, to look at the Loan Market Association's definition for sustainability-linked loans in the first instance. And that definition talks about any types of loan instruments or contingent facilities for which the economic characteristics can vary depending on whether or not a borrower achieves, and I'm going to highlight this, ambitious, material and quantifiable predetermined sustainability performance objectives. And the reason for highlighting material, ambitious and quantifiable is because that's something that we're going to have to talk about in quite a bit of detail when we get to the how we put in place sustainability-linked loans and actually in assessing their impact. But looking firstly at the economic characteristics, what that really means in principle and in practice is that the pricing of a loan will change depending on whether or not the borrower hits their sustainability targets. And that's most commonly achieved by a decrease in the interest rate that applies to the loan if the targets are met. And it can work two ways. So it can mean that your interest rate goes up if you don't hit the targets that you've been set or you've set for yourself. In terms of the wider principles of sustainability-linked loans, they really are viewed as a transition tool. So they are designed to help borrowers on what is termed, I hate the word journey, but on their transition journey in terms of helping them to improve their sustainability and performance and to really give incentives in terms of meeting their sustainability performance. And technically they are available to any borrower. So it doesn't matter what industry you're in, but technically they can apply to any borrower at all, provided that they can comply with the strategic elements needed to align with the 5 core principles of sustainability-linked loans, which are set out by the LMA in their sustainability-linked loan principles. And those 5 principles are selection of key performance indicators or KPIs, the calibration or choosing or selection of sustainability performance targets or SPTs, loan characteristics in terms of looking at how a loan might need to develop over the course of the life of the term of the loan, reporting in terms of agreeing methodology for assessing the SPTs that have been set up, and then verification. I know we've got some verification experts in the audience this evening, so don't judge us if we get anything wrong on that side. But verification and determining exactly how and evaluating performance on SLLs. So we'll come and speak about those in sort of specific terms in a few moments when we get into the nitty-gritty of how SLLs operate. But before doing that, it's probably time for me to pass over to some of the panel and thought it would be useful to just start off by actually determining why we're talking about sustainability-linked loans and what the benefits of them are, And Suchita, I think you're probably uniquely and best placed really to answer that from a borrower's perspective. And so can you maybe explain to us what prompted Harbour to look at putting in place a loan with sustainability linked principles and what you see as the benefits from a company's perspective of having such a loan in place?
Yeah, sure. Is my mic working? Can you all hear me? Yeah. The request for sustainability linked mechanics in our loan documents was very much company driven. Was round about 2019, I think. And to my knowledge, we're one of the first, if not the first, reserves-based loan facility in the market in Europe, certainly, to have sustainability-linked loan criteria put in. And I think, at the time the company was on a growth path, and we wanted to be on the front foot with regards to having a sort of credible ESG strategy, and most importantly to sort of retain and bolster creditor support. And so how we went about it is, so every year we do a materiality assessment in the context of our annual ESG reporting, looking at what's important, what's material for ourselves and our industry from an ESG context. And unsurprisingly, one of the main KPIs coming out of these materiality assessments is climate change and greenhouse gas emissions. And so, I mean, Harbour's set for itself a sort of public commitment of net zero by 2035 in terms of gross operated scope 1 and 2 emissions, with an interim target in 2030 of a 50% reduction in emissions as against a 2018 baseline. So the KPI that's in our loan documents as well is related to the reduction of carbon emissions. And they're ambitious targets in the loan documents. They keep us right in the context of our overall ESG strategy. And we see a small uptick in savings on the cost of drawings as a result as well.
Great, and so you do see benefits deriving from having that SLL in place?
Absolutely,
yeah,
absolutely.
Great. And Nick, from a lender perspective, do you see SLLs as sort of a key tool in your future investment into oil and gas companies? And are you sort of under increasing pressure to make sure that loans that are sort of deployed to the oil and gas sector in particular are linked in terms of sustainability targets?
Yeah, sure. I mean, just check you can hear me, which you can. So yeah, I think to your question on are they a key tool? I mean, as a bank that advocates for SLLs, I will say yes. I think to my mind, look, SLLs really, I think, strengthen the link between a sort of transition strategy and a sort of executable plan, and then sort of consequences and incentives by achieving that or not, both financial and otherwise. And I can maybe come on to that a little bit. And I think what it kind of creates is additional sort of skin in the game for corporates as it relates to their energy transition plans and targets. One of the features which you sort of referenced in the slides is the pricing component of SLLs, and that I think is obviously a key feature. I think the sort of materiality of that can vary between corporates. For example, if you have a corporate that sees their credit facility as a sort of a primary source of funding in its capital structure, then that's going to be more impactful for them versus a corporate that sees it more as a kind of liquidity backstop. But I think a couple of other sort of features or consequences, I guess, that I would point to in the context of sustainability-linked loans. I think number one is access to capital. So SLLs are increasingly a mainstay of the European loan market. I think within the energy sector specifically, they're increasingly becoming a prerequisite for lenders. So I would actually say, sitting here today, that for companies, particularly in certain subsectors such as upstream, I think an SLL is really a facilitator to continue to access capital, and an absence of it is potentially prevents you from doing so. And then I think the other feature I'd also point to is sort of the reporting element of SLLs. Particularly for companies that aren't necessarily in the public domain and aren't required or obligated to publicly report ESG performance, then I think the reporting components of an SLL placed an onus on them holds them to account, I guess, in terms of their energy transition strategies, and also has sort of a checks and balances to it in the form of external verification, which we alluded to as well. So I think those features, to my mind, mean that they are an effective tool.
Great. And from your perspective, from DNB, do you presumably have similar thoughts on that? But yeah. I guess in terms of pricing and whatnot, do you see that as a further carrot, or do you think it's more like, in terms of what Nick was saying, that actually it's more about capital being available?
So I think the discount that the borrowers tend to make might be part of it. Maybe Suchita, you can actually confirm or deny. But I think the benefits of SLLs go way beyond that. You know, Nick pointed to the access to capital, just a better liquidity, just because investors are more and more interested in these products. I think is the big one. Demonstrated to stakeholders the organization's commitment to sustainability. Because of the additional liquidity in the market, potentially better pricing achieved, as well as lower execution risk for those transactions. And last but not least, I think better cooperation around sustainability issues, both externally and internally, just because of the increased dialogue. So I think DNB is well aligned with Wells in that regard. It's become very much market standard. We look at it for every transaction that we look at. Sometimes it doesn't make sense for certain borrowers, or sometimes the timeline of the transaction will not fit, because it is a process that takes some time to go through it properly. You know, if the transaction timeline is directed by an M&A transaction, for example, it might not be appropriate to do it on the spot. But even then, we kind of tend to include an undertaking in the documentation that says we will include these KPIs by 6 months from now. So we're very much focused on it.
Great, thank you. And Emily, I guess you can sort of look at it a bit more holistically from an outside-in perspective, not either being the recipient of a loan or a bank that gives them. What sort of impact do you think SLLs are having? Do you think they're having a genuine impact on people's behaviour?
I think it's a great question. I, as a certified tree hugger, would like to hope they're having a genuine impact. But I think in a number of instances, yes. So you mentioned earlier some research that I've done as part of some work I've been doing with Cambridge Institute for Sustainability Leadership. So looking at a number of loans in the market with publicly available data and trying to say, do we genuinely think that those organisations are trying to achieve their objectives, align with the LMA, and genuinely decarbonise their businesses? And I think the interesting observation we had was up to 80% of those loans were questionable. So when we looked at them, would we have serious questions that we'd like to see answered? So I think they have a genuine role to play, absolutely. I actually think that we will get to a situation where all lending will become sustainability linked, and actually we'll probably start to see margin ratchets associated with you're not very sustainable and you don't have a credible transition plan, ranging to you do have a credible transition plan, and we can see how that's going to play out. So yes, really valuable role to play, but a lot more work to do, I'd say, to be genuinely credible. And I say credibility, despite the fact the LMA doesn't have the word credibility in their criteria when assessing a sustainability linked loan. It does feel like the obvious omission.
Yeah, and I guess what they do say is materiality, and that is probably kind of the key to what you're saying, is that actually in order to really assess impact and to use SLLs in a way that achieves what we want, which is a transition that works for what traditionally heavy industry, the materiality and the setting of KPIs and specific targets is probably what we need to look at. And that quite neatly takes us on actually to looking at sort of the practicalities of putting sustainability linked loans in place and really how we want to go about them. And it's probably just worth pausing on what we mean by KPIs and SPTs, because there's quite a bit of jargon that gets thrown around. So when we speak about KPIs and key performance indicators, when you look back at the LMA's guidance on that, really what they're focusing on in terms of KPIs is the wider issues. So your E, your S, or your G, your environmental, social, or governance issues that have sort of the biggest impact on a borrower's activity, whether it's their strategy, whether it's their operation, whether it's actually sort of financial performance. And when identifying KPIs, I think what we're really trying to achieve is looking at the most important E, S, or G, or maybe a mixture of both, challenges for the borrower and probably within the context of its industry. Whereas when we look at sustainability performance targets, SPTs, actually that's more looking at the specific targets that we're trying to set. So, you know, a specific reduction in carbon emissions, or a specific reduction in greenhouse gas, or it might be, you know, if you looked at it in a mining context, specific use of a certain percentage of local, you know, local based employees, or whatever it might be, but looking at actual targets and probably based against industry metrics is probably the key, particularly within an energy context. And so I guess, Emily, sort of staying with you on that front, from what the research that you've done and your experiences, do you think that we have best practice in this regard, or do you think that there's still some way to go on that front?
Around target setting specifically?
Yeah, I think so.
Yeah, I think we have to recognise, actually, on the broader topic of sustainability, that actually it's relatively nascent. We're learning a lot about our environment and society and what we need to do to improve it. And therefore, partly I think we need to be a little bit kind to ourselves, because we don't actually know all of the answers. You know, CCUS isn't perfect. We don't have perfect solutions to all of the problems that we're facing into. So let's be realistic that I think genuinely the people working in this space, setting targets, talking about KPIs, are trying, and actually the banks that are trying to fund them are genuinely looking for credible, stretching KPIs and SBTs. And however, I think the challenge they are facing into is everything's changing around them all the time. We're seeing credible pathways in the market start to move and change. The IEA NZE doesn't allow really much flexibility, particularly in this market, for things like new oil and gas exploration. So I think people are genuinely trying to do the right thing. I think it's a challenging environment where there's new information and data all of the time. And therefore, what becomes really, really important as part of the process of putting that SLL together is making sure there's a really, really robust annual review process that allows for some flexibility as things move and change, and we find more information about what's important in terms of how we drive decarbonisation and other metrics.
Yeah, and I think that sort of concept of evolving as we move through is important, and it probably touches on the loan characteristics aspect of you know, the core components there, because it's all very well, and Anne, you can maybe speak to this, it's all very well sort of putting in place structures and targets on day one of a 5-year facility, but actually how do you as lenders approach that KPI setting process, knowing that we are in an ever evolving market, and things are probably going to need to change as you move through the life of the loan?
No, absolutely. I think, you know, the ever-changing game, you know, the ever-changing nature is spot on. I think, you know, taking a step back, I think obviously this panel focuses on the E and ESG mostly, but perhaps it's worth kind of, saying that a few years ago, we would set an SLL with just one KPI, and that would be emissions typically. These days, the SLLs that we deal with tend to have 2 or 3, and yes, emissions more often than not will be one of them. That's the main one, the most common one. But on the E side, you also see KPIs around recycling, energy procurement mix, things like that. And then on the S and the G, you see a lot of gender equality KPIs, you know, both diversity and other things like that, you know, training, HSE incident, things like that. We're a sector-oriented bank, and so for each sector, you've got materiality grids. So we refer to that when choosing KPIs. That's a good baseline. I think one key thing to look at is the company's strategy? Have they set external KPIs? Have they got targets in place? If so, it makes sense to align with those for their financing. And also have a risk-based approach. Where the main gaps for this company, where are the biggest risks to their even credit profile, and kind of target those with the KPIs. But maybe Nick, you want to elaborate a bit more on how we go about setting those KPIs?
Yeah, sure. Look, I mean, I agree with that. I agree with how things have evolved in terms of the breadth of KPIs that you see in the market today versus where we were in, say 2019, for example. I think in terms of the practicalities of actually setting the KPIs and having kind of had first-hand experiences in sort of a coordination capacity in some of these processes, including some that are sort of active now, we sort of tend to do this sort of dance between what's kind of desirable versus what is practically achievable. And I think the important point there is, I think to Emily's point, we need to be pushing corporates to outperform, but equally we don't want to set them up to fail. And I think that balance is difficult to find, but I think that's key. And I think if I talk a little bit about the upstream sector, where I'm kind of more focused, and as a bank, we've kind of been involved, particularly in sort of ESG coordination roles. Some of the key debates that kind of come up as we're setting environmental KPIs are, for example, should you focus on carbon intensity versus absolute emissions? And I think what we see is there isn't necessarily, a single answer on that. If, for example, you have a company that has predominantly later life fields in its portfolio, actually carbon intensity can increase as a function of decline in production, even if you're taking measures to actually abate emissions. So in some cases, then absolute emissions can be more appropriate. Similarly, the way we set a KPI trajectory for a company may differ depending on the level of operated versus non-operated or passive asset interest that it has in its portfolio. And then I think a topic that's I think inevitably a hot topic, and I think coming up increasingly, is how should we set the scope of emissions under KPIs? I think lenders, I would say, kind of maybe going back to your first question a little bit, are under increasing pressure to try and implement scope 3 into emissions targets. On the other hand, what we hear a lot from corporates, I think understandably, is that it's hard for them to really control and influence scope 3. So what we've started seeing are some sort of more novel KPIs being introduced. For example, those that incentivize, say, investment in things like CCUS, which is still a nascent sector, but is one that does at least indirectly address scope 3, noting that, if you have an emissions target that includes a scope 1, scope 2, and scope 3, for some companies, the scope 3 piece may be so large that it sort of dilutes the impact they can have on scope 1 and 2. And then the final point I mentioned, because you referenced, industry standards. I think when we're setting KPIs, we do often look through to industry standards. So, for example, for a UK-based borrower in the energy space, we may look through to things like the North Sea transition deal to take cues on what is an appropriately kind of credible and ambitious, target when we're formulating these KPIs.
Yeah, and I think from a legal perspective, that's sort of replicated if you look at the new LMA drafting that's come out actually really just in the last 4 weeks or so, and the KPI definitions, if you like, in there, whilst very vague, do actually try as far as possible to push through to those industry standards. So I guess in terms of a takeaway for anyone listening, in terms of looking at how you might go about that, it's probably safe to say that looking at industry standards is an initial good thing to do, and pushing them from that perspective. And Suchita, from the company's perspective, you obviously were early adopters in terms of putting in place, and you spoke about some of the targets that you have in place already. Did you find that your lenders, bear in mind 2 of them are here, did they challenge you on those? Did you find that you sort of were pushed and they were negotiated beyond what you were maybe initially comfortable with? Or do you think you had set sufficiently ambitious targets in the first place anyway?
I mean, look, as I mentioned, the loan mechanics were put in the context of these materiality assessments that we carry out, and the company as such has made this public commitment to net zero, which is at 2035, so some 15 years ahead of the North Sea transition deal that Nick alluded to. So I'd say the choice of KPI and the target levels themselves were relatively uncontroversial with our syndicate. We commissioned a report back then, and essentially we have quite a sort of classic SLL mechanism where year on year we measure performance output as against the baseline, and then look at where that slots into a sliding scale of performance outcomes, and then that ties into a margin ratchet. So an X% decrease in emissions translates into a corresponding decrease in the margin. But where we had an interesting discussion was around the other end of the scale. So what happens if we don't meet our targets and we end up paying a premium basically on the margin? And so, are the lenders essentially sort of profiting off us not meeting our ESG ambitions? And it was the early stages of this ever-evolving mindscape, and we had a bit of back and forth at the time on it, and we ultimately got to a position where we have a provision essentially saying that the lenders would look to apply those proceeds towards other suitable ESG initiatives. Now, I'm sure since then many other borrowers have come to market. A lot of our peers have SLL mechanics in their loan documents, and I'm sure there's innovative approaches that other borrowers are sort of challenging their banks to take these days. So when we come to refinance, I'm sure we'll have more interesting discussions around that. And I think the second sort of topic of negotiations that we'll probably more likely come to see when we come to refinance is what Anne was talking about. A lot of our banks have beefed up ESG teams now. There's a lot of expertise within our banking group, and no doubt we'll be asked to look at not just the one KPI, but 2, perhaps 3, and touching on the sort of S&G aspects of ESG as well. So there'll be some interesting discussions to come, I'm sure.
And no doubt you're already thinking ahead to them.
And perhaps I can add to that, once you start having 2 or 3 KPIs, you can affect weights to each of these KPIs. So if emissions is your main one, you could say, okay, if the overall discount is 5 pips, plus minus 5, you could say, okay, emissions is plus or minus 3, and then you put 2 on gender diversity or something like that. So that's also a way to reflect materiality.
Yeah, and that is a good point, and that's reflected as well in the new drafting that's come out. So again, looking at the margin ratcheting and specific drafting without getting too technical, because nobody wants to get into legal drafting, but that is very much reflected in what the LMA have brought out in the last few weeks as well. So it does seem that kind of increase from one KPI or one SPT rather to 2 or 3 does seem to be kind of flowing through the documentation that's being put in place. And Suchita, maybe staying with you, because you mentioned sort of monitoring and kind of the reporting that you do, and I think that's probably kind of moving into sort of core components 4 and 5 on the kind of key characteristics of an SLL. Do you find from a reporting perspective that you've got more to do now? And I know you mentioned that you were sort of doing those reports anyway, so it maybe hasn't massively impacted on your day-to-day reporting, but do you think that you have added obligations as a result of having sustainability targets?
Yeah, I mean, you're right. We do the sort of public reporting on this topic anyway, and the reporting that we do for the lenders is a subset of what we publish externally, and the data that's captured is a subset of the data we capture for the purposes of our external reporting. I guess where sort of there's more time is spent for these sort of SLL aspect is, well, originally sort of setting up the framework and making sure we got that right, and then sort of annually, I guess, measuring how we've done as against that baseline. And then, we've got a verification mechanic in our loan facilities as well, where a third-party environmental auditor looks at our reporting and essentially provides that additional level of assurance. And that report then goes to our banks together with our kind of certification of the report for that year. So there's a bit of additional reporting in that sense, and then running through the process with the auditor. But the kind of baseline figures and the capturing of the data we do regardless. I suppose, to the extent we start introducing other SPTs into our documents, I'm sure that will bring on additional monitoring and reporting that will be needed to the extent we don't otherwise report on those aspects externally.
Yeah, so there is additional management time that is needed, but I guess it's weighed up against the benefits that you mentioned earlier in terms of the SLL generally. And from a lender's perspective, Suchita mentioned sort of external verification. Do you as a bank have a preferred approach in terms of how you go about reporting? Do you tend to require that external valuer? Do you tend to have maybe a sustainability coordinator? I know Nick mentioned that when he was speaking earlier. How do you as a bank tend to look at that?
So I think DNB, we don't have a hard rule on whether we go with the auditors or whether we hire an external consultant, industry expert. I think it's mostly driven by the governance structure of the company. Do we trust their figures? Do we trust that the board is involved in their ESG policies and strategies? But perhaps Wells will have a different view.
Yeah, I mean, I think the first thing I'd say is, from what I said out, I think external validation is just now a market standard feature of SLLs. I'm aware that the level of reliance that banks require from that can vary a little bit. Typically we're happy to accept sort of limited assurance validation. I think the nature of the validation can vary a little bit on the sort of the type of corporate, I think somewhat to Anne's point, but if you think about a company that has, for example, existing public ESG ratings and reporting that goes with that, we can perhaps take comfort as lenders looking through to that, albeit we may want some supplementary verification from, say, a financial auditor. But I think in circumstances where you maybe have a private company and or a company that has more technical KPIs, which can be, relevant particularly in the energy sector, then, we may favor looking to a sort of industry specialist or industry consultant to provide that validation.
Yeah, okay. And Emily, from your perspective, kind of come back to that best practice aspect, and how do you think that we should be looking at reporting and monitoring and evaluating sustainability linked loans? Do you have a view as to kind of what best practice should be, or is it a bit of a tricky question because it will inevitably depend a little bit on the industry that you're talking about?
I think reporting itself in this space is a tricky question, and actually a real challenge for many different organisations because of perhaps the complexity and the global nature of their business models and the different regulatory requirements. I think in terms of reporting specifically in this space, I guess it's really, really important from a verification point of view. I know the LMA talk about that, but we haven't seen that as best practice actually historically. So I think that's a key element. But I think also transparency is quite important. So being able to genuinely report and provide the level of detail that the banks themselves need, to Nick's point, to be really, really comfortable with the data, to be clear about what you know and what you don't know. So a lot of proxies are currently used at the moment for a lot of the data, let's be honest about that. And being able to be really, really clear about where you have actual data, where you're relying upon third parties and where proxies have been used, I think it's really, really important. Then I think, again, just to the really critical part for me is the transparency piece.
Yeah, and I guess the transparency piece sort of takes us on to looking at some of the challenges that exist in terms of SLLs and I guess sort of green finance generally, because there have obviously been a number of accusations and discussions around, oh, well, it's greenwashing, it's this, it's that, it's not actually having the impact that we need and we want. So that transparency piece really does become critical, doesn't it, in terms of ensuring that there is, and it comes back to the question, the point on credibility that you raised earlier. How do you think that we can really go about ensuring that SLLs are transparent and are credible? Is it just about having sort of agreed practices in place to avoid accusations of greenwashing?
I think the LMA is improvement to the framework. So I think if we look at regulatory standards that sit there, a lot of organisations are relying on the LMA, but actually if you look at the guidance, it has historically been quite high level and quite loose in its definition. So a lot of people are then trying to fill gaps underneath that. So I think that's a problem. So greater level of guidance, I think, is what everyone's looking to make sure that they can feel certain around the transaction that they're creating. So I think that's definitely a move in the right direction.
And I guess there are sort of increased disclosure requirements. The FCA is consulting on sort of green and sustainability disclosure requirements generally. So that hopefully will start to move us in the right direction there. And I think one thing that you and I discussed at one point was in relation to actually establishing transition and what we really mean by transition. I wonder if that's something that you wanted to talk about in terms of looking at the oil and gas sector and oil and gas companies and really establishing a transition process.
Yeah, I think there's a couple of things there that you talk about. So we, as you will all know, have the EU taxonomy. That is actually fantastic because it kind of gives you a guide that helps you to understand how you might think about some of the lending. So I think actually just to take a step back, I guess you'll all know many of the banks have these massive sustainable finance targets. So they're really, really keen to be able to classify lending as sustainable finance. That's fantastic, but they want to be able to genuinely evidence then to the market, absolutely, that transaction was sustainable, not just a general transaction that we would do with you. So I think that you touched on kind of the UK and the direction we're moving in there. We've obviously got the EU taxonomy. We're looking forward to, I would say, the green taxonomy, which I think is going to be the UK's equivalent. I suspect it's going to look very similar to the EU taxonomy, but we'll wait and see what happens there. And I think that's really positive because it gives guidance as to what might be sustainable versus what might be transition finance. And I think we're increasingly seeing our clients in the banking space starting to be really, really clear about differentiating between what a sustainable finance taxonomy and what a transitional finance taxonomy might look like and how to classify those separately. And then that kind of, I guess, takes you back to what we'll see in the SDR in the UK or SFDR in the EU, which is kind of those green sustainable funds that we see in the market versus a transition finance type fund.
Thanks, Emily. And from a banking perspective, how do you sort of deal with the position where you're funding energy companies in sort of traditionally heavy industry and balance that against sort of the concept of sustainability loans? And I guess it's sort of a twofold question because there's obviously a risk element there for you in the sense that you've got stakeholders who are keen that you, as Emily says, deploying sustainability linked loans, but you've also got reputational management there in terms of making sure that what you're doing, it can't be classed as something that's greenwashing.
Yep, no, absolutely. I think there's definitely skepticism around, whether sustainability linked loans are appropriate for the energy sector, if they contribute meaningfully to a transition or if they're just used as a public relations tool. There's also diverging views among banks around what KPI should be used or if SLL should be used at all for upstream companies in particular. And so one consequence of that is that, for the transactions that Nick and I are involved in, even though those loans, I'm not going to call them SLLs, loans meet every single one of the LMA, LSTA criteria. The KPIs are ambitious, material, quantifiable. There's annual reporting. It's being verified externally. Even though that meets every one of the criteria, the loan will not get the SLL label. And in fact, banks are going further. I've heard that banks are now including no marketing clauses in documentation, which precludes anyone party to the documentation from marketing the loan as an SLL. So it tells you a little bit about the level of cautiousness from the banks. One point of view could be, of course, that there will be a transition, but while we build the renewables capacity, fossil fuels will be needed, and therefore any carbon that you're able to take out of the atmosphere is a good thing. And so these loans, because of the engagement and conversation that they allow between lenders and borrowers, are a good thing and should be encouraged and pursued.
Yeah, and I guess there's an element there of looking at it. We talk about it in the context of energy transition, but actually our views on what constitutes the energy transition have really changed in the last year since we've had the Ukraine-Russia conflict, because I guess there's now questions of energy security being brought into the mix that maybe weren't there a year ago. And so whilst people might have been very hesitant to provide an SLL to an oil and gas company or a heavy mining company, actually now we can look at it and say, well, the reality is we need to transition, but we can't just switch off oil and gas. That's whilst we've got this energy security issue, that's not something that we can just do. So I guess, Nick, do you see SLLs having perhaps a greater role now because we've got an energy security issue than they might otherwise have done?
Yeah, I mean, I think just to pick up a little bit on what Anne said as well, I mean, we're seeing those same trends, and I think from a Wells Fargo standpoint, our kind of philosophy, if you like, on energy transition is that we want to sort of support, I guess, all subsectors across the energy spectrum, because we see all of them being equally important to the transition. So we have sustainable finance targets in terms of capital commitment. We, unlike some of the other banks that Anne mentioned, do classify sustainability-linked loans as sustainable financing, because our view is that supporting traditional fossil fuel sectors to be more sustainable is also part of the energy sort of transition journey. I think to your question around will these become increasingly a mainstay, I think the answer to that is yes. I think to touch also what Emily was mentioning around reporting, I think SLLs are an important way to try and bring better consistency in terms of reporting. One of the things we often hear from corporates is that if, for example, they have a passive or non-operated interest in an asset, that they're sort of at the mercy of their partners in terms of being able to report, which I think is a valid point. But I think if we get SLLs becoming more commonplace in the market and having more consistent reporting requirements, that's going to be better for everyone in the context of sort of energy transition.
Thanks, Nick. And Suchita, just lastly coming to you on kind of the concept of greenwashing, do you have any concerns from a company's perspective? I mean, I know Harbour has set out really ambitious targets in terms of net zero and whatnot, but have you had any concerns or around having a sustainability linked loan despite being such a big player in the oil and gas space?
No, and that sort of ties into something Nick mentioned earlier. I mean, it's essentially a prerequisite to creditor support. We fully recognise that, and until we have reliable alternative sources of energy, investment in oil and gas isn't going to go away. It's going to be needed to meet those energy demands that you were talking about and to help deliver the energy transition. But creditor support for the sector is waning. There is that increased focus and requirement on companies in the sector to deliver the transition in a responsible fashion. And for that reason, SLLs are going to be a quid pro quo to retaining and, well, retaining possibly the creditor support for the sector. I was going to say bolstering, but yeah, retaining creditor support for the sector.
And actually that probably answers the sort of last question that I was going to ask everyone, which is, do you see the use of SLLs increasing in the context of an energy transition? So I think from your perspective, that's definitely a yes.
Absolutely.
And Nick, you've pretty much told us the same from your perspective.
Yeah, I would agree. I will actually, because I realized I didn't fully answer your question around the balance with energy securities, maybe just to comment on that. Look, I think, that does create a little bit of a different overlay in the context of SLLs. I think the key thing there is setting SLLs that appropriately incentivize, oil and gas companies to continue operating, but operating as sustainably as they can. But there obviously is a balance to be found there, and that isn't necessarily an easy one, and that will continue to evolve. I think we're feeling better about life right now in terms of energy security in Europe, but let's see where we are in the depths of winter. But I think in any event, the SLL product will, I think, continue to become become more of a mainstay in the market.
Thanks. And I guess the same question, Emily, do you see SLLs continuing to kind of become more commonplace in the market in the context of the transition?
Absolutely. More and more banks are setting their own targets in terms of emission reductions, and so we look at that when we set an SLL and how that SLL is going to fit within that framework and how we're going to be able to be compliant. So absolutely, and again, the engagement and dialogue that creates between borrowers and lenders, I think, is key.
Yeah, and yeah, absolutely. So to add on to Anne's point, given the banks all have not only sustainable finance targets, but also really ambitious net zero targets of their own, I think we're only going to see this become even more mainstream. And I think increasingly lots, or if not all, loans having some kind of sustainability linked KPIs associated with them is the way the market's going.
Great. Well, thank you all very much. Hopefully that was useful, interesting, certainly from my perspective, really good to get all of your viewpoints on SLLs, and hopefully a kind of practical session in terms of some takeaways. We do have a few minutes left if there are any questions in the audience. I would just note, obviously, these are representatives of companies. They can't give carte blanche, policy information or future, so bear that in mind when asking any questions. But if there are any in the audience, and apologies, I don't know if the chat function is working on the webinar, so if anyone listening on the webinar has any questions, maybe just email them to me afterwards. There are contact details there, but we have got questions in the room. Yes.
Hi, John Clark from EY. That was really interesting. Thank you, everyone, for giving up your evening and actually for doing it in person, which is much more valuable. My question, it was great that you touched on energy security, because I think as this market has evolved, I'll start again. It was great that you touched on energy security. I think as this market has evolved, people have realized energy is a much more complex sector than the often misquoted IEA report, which says, let's not explore in the UK because there's plenty of oil and gas in Russia, so the world will be all right. But we do seem to create lots of ways to make our domestic industry less competitive globally than it could and should be. My question is, how do these products compare when you look at different markets around the world, and how do you see the cost of capital developing in different markets? Because ultimately energy is a global commodity.
Yeah, I'm happy to take that one as one of the bankers in the room. So to your question around what we see in different markets, I mean, look, as a US bank, we naturally have good visibility over what we see in the European market and the US market. I think in terms of the SLL product and some of the key principles, we don't want to see much in the way of material differences in terms of the actual frameworks themselves, in terms of the way that KPIs are formulated, in terms of the the reporting requirements. I think one of the differences though is the European market is frankly a bit further ahead, in the sense that as we discussed, SLLs are becoming, just more commonplace, particularly in the energy sector. If you look at the US sector, by example, Sashita mentioned that they were the first RBL borrower in this market to implement an SLL in 2019, I think you mentioned. We've only just now seen the first RBL in the US implementing an SLL. So that just kind of gives you a sense of how the two markets are moving. In terms of the impact on cost of capital, look, I think there's a pretty clear direction of travel independent of SLLs, that cost of capital for upstream is increasing. I agree with you that, some of the rhetoric around this, if you like, and actually some of the policy making is probably not helpful, particularly as it relates to incentivizing, further investment, particularly greenfield investment in the space. I guess part of me does hope that the SLL product may actually help facilitate that. Because I think one of the things that kind of gets overlooked oftentimes is that, you know, greenfield developments, as you know, typically have very favorable, you know, carbon intensity metrics or other environmental measures relative to existing, you know, operating assets. And again, I'm talking more specifically about the upstream space. So that should be a reason, in my view, to incentivize those investments, and more importantly, to incentivize capital to support those investments. So I think the SLL product, I think, can potentially help facilitate that.
Thanks for fielding that one, Nick.
Quick one.
Yes,
Yeah,
and
so-
if you wouldn't mind passing the, oh, you've got the microphone.
Can you hear it okay? Is it coming through?
Organised.
I haven't made a microphone. Quick one, you mentioned about SLL becoming a mainstay of the industry, perhaps directed to Lisa and her research. Is there any evidence that over the last 6 months or so, as sentiment is starting to shift around a little bit, that the enthusiasm for SLLs or SLBs for that matter on the bond side is slowly retreating or starting to wane? Is that coming through any of the evidence or research that you're doing?
I would actually probably redirect that, I think, to Anne and Nick, who probably see more flow of deals. The evidence that I see is increasingly really stretching aggressive targets across the industry from the banks around, you know, lending as much as possible in the sustainability linked lending space. I think we then see companies understanding that, and sometimes I think that can be a little bit of a challenge between the desire to want to fund something sustainable versus the companies saying, we know that you're really keen to get, you know, sustainability. So there's a little bit of a misbalance sometimes of power it's feeling at the moment in the market, in terms of banks being very keen to fund sustainability linked lending, and companies therefore sometimes offering things up that perhaps aren't as robust as we'd like to see in the market. But I think Nick and Anne can probably better answer that question.
I was just going to add into that as well, because we've done a little bit of research internally just on the kind of volume of SLLs that have been, you know, come out in 2021, 2022 and 2023. And certainly looking at the 2022 figures, there was a large increase certainly in terms of the overall value of SLLs in the oil and gas space in particular, up on 2021. I think it's something like 3 times the value. So in terms of an actual increase and shift, I think it does ring true that there is an increase in the number of SLLs that are appearing in the market, but very happy to let the banking experts talk about that.
Sure, go on.
Sure, yeah, look, I don't think I'm a huge amount of what I agree with that. I think the trend is pretty clear. I think if you look at 2021 and 2022 in particular, we saw a big kind of needle move in the number of SLLs in the European market. I think to the point that Emily made around the credibility of KPIs, I think what corporates are probably increasingly finding now is that when they enter into discussions around implementing an SLL, most of these, just for avoidance of doubt, generally come down to sort of an all lender or all bank consent process when you're implementing them under the facility. The point there being is, you know, clearly as a function that you're working to the lowest common denominator. So if you're talking about putting together large facilities across, you know, a very large syndicate of banks who will have different perspectives, you're ultimately kind of being forced, if you like, to make it achievable, to make it credible, because you have to sort of tick everyone's box, if you like.
Oh, there is another question. Pass the microphone over. Oh, Anne, did you want to add anything on that? No. Okay, Dougal.
Yeah, just a question. It may be of no relevance. I'll ask it anyway. So in the bond space, there's, you know, more and more movement towards the EU green bond regulation, and that's starting to take shape, and it'll kind of probably come into force in the relatively foreseeable future. For the moment, it's just green bond, so it's a use of proceeds concept, and eventually, you know, there could be a revisiting of that to extend it to a sustainability linked bond EU label. I guess the concept is that if you have this EU green bond standard that you can stamp on your bond over and above doing a, let's say, an ICMA compliant sustainability linked bond, that you'll get a kind of a super greenium as an issuer coming to market, because the investors in the bond space will like that kind of bond product that has that super green label. Is that something that people in the loan space look at as having potentially any relevance to how the loan market should try and orient itself? Or do you think people are broadly satisfied with the sustainability linked principles from the LMA and kind of a market driven, if you like, approach to things? Or could there be any value in having some sort of overarching super sustainability linked stamp by any kind of regulatory body?
I think what would help is some regulatory update on, cost of capital for banks for these products, and I don't think that's coming anytime soon. Not for the energy sector anyway. That's still got a premium on it rather than discount. So any green, like you said, green loans or bonds, i.e. use of proceeds for a green project, we can sort of internally tick a box and then we get lower cost of capital. But for the energy sector, that's really not the case.
Well, I would say just one comment. The bad news for the green bond standard for securitization, which is relevant to banks, is that it won't be possible to include any exposures that result from financing in the fossil fuel sector, subject to very limited carve-outs, which is probably not great for banks carrying those exposures. It's just more bad news. But I think the cost of capital of this for this sector is vital and needs to get solved, because I think that's one direction of travel that's going the wrong way. And I think there's some recognition of that, but it does seem to be a car crash waiting to happen.
Yeah, maybe you'd like to comment. I mean, I agree with that. And what we're also seeing is, I think sitting here today, look, the bank market is still functioning. There's still adequate liquidity, but there's been some public announcements from some banks recently in terms of their lack of willingness to continue supporting the sector. What we see is that the need for capital isn't really going away. And so what that means is that the pool of capital transitions from the banks to somewhere else, and that somewhere else could take a few different forms. But the point is that may then move to sort of sectors or sources of capital that are not as well regulated, that are not as publicly scrutinized. And actually, I think on a net basis, that's probably not good for the sector. I think that's one point. To your point around the sort of the loan product, I mean, one of the things that we have been thinking about, I'd say it's more conceptual at this point, is having kind of green use of proceeds tranches within loan facilities, to the oil and gas sector, for example, to support companies undertaking investments in things like CCUS or hydrogen or offshore electrification, to allow for that. But I think the idea of kind of stamping that, if you like, as a sort of, a green loan, that I think comes back to the challenges that Anne was mentioning, which is just the public perception issue that banks are sort of contending with, and perhaps a lack of willingness from some lenders to actually have these labeled as such in the sort of public domain.
Perhaps one funny story. I was looking at a company that is looking at CO2 carriers for a CCUS project, and we're like, okay, well, surely that's going to get the green tag. Or actually, no, because even though they're carrying CO2 for a CCUS project, they still emit, so we can't tag them as green. So it's all very challenging in what we can or can't call green and get that discount on. So.
Great. Well, I think we are probably just about at our time. So just leaves me to thank all of our speakers again for giving up their time. Very much appreciated. And to thank everyone online and in the room for coming today. Hopefully it was useful and interesting, and certainly for those of us in the office here, hopefully we can escape to the slightly cooler room next door, because it's very warm in here. So thank you all very much for coming, and thanks to all the speakers again.